The average cap rate in the Hampton Roads might look nice and stable, but when you dig into the data, you'll see something very different is happening. Nearly half of all multifamily listings are currently slashing their prices across the region. And in some submarkets, it's even more than half. Even in some of the most resilient markets, one out of every three sellers are starting to flinch on price. This isn't a calm market, it's one that's recalibrating quietly but fast. This is your Q4 2025 Hampton Roads multifamily market update. Let's dive right in. So when I say that nearly half of all listings have slashed their price, why is that? Well, I personally think that's because you have a lot of sellers that tried pricing their assets too high. Market's not responding there. A little bit later in the video, I'm going to show you where we are at actively with inventory relative to transactions. That's mind-blowing. When you see what's happening there, you'll understand why a lot of these listings are having price adjustments. We'll then be taking a look at data on days on market, months of supply, all the factors that help explain why there are so many price cuts. But ultimately, it comes down to sellers who overprice their assets, and the market's not there to pay them what they want. So now they're trying to find the right price by coming down either a little bit or a lot. When you look at it broken down by submarket, you can see here what that distribution looks like. Across the Hampton Roads, which includes Norfolk, Virginia Beach, Chesapeake, Newport News, and their surrounding submarkets, we're looking at significant price reductions across the board. Now, when you look at the different submarkets, Hampton Roads as a whole has had more than half of all C-class listings reduce pricing. The average reduction is sitting at 8.1% in some submarkets. It's a lot higher than what you're seeing in comparable mid-Atlantic markets. On a $10 million asset, that's at least $810,000 in price reduction. $610,000 on a $7.5 million property. The submarket seeing the most aggressive reduction, Hampton itself, parts of Newport News, and Norfolk City are all experiencing significant pricing pressure. Now, where are these reductions concentrated by asset class? Broken down, you can see that the lower end of the market, properties trading at $100,000 to $120,000 per unit, those are going to be mostly C-class value-add assets. Some Class B minus workforce housing, over half of all listings in this bracket have had a reduction. Now that's counterintuitive when you think about it because you would assume that the more affordable the base is, the higher the demand. But I think you also have sellers that are trying to price these assets way higher than what buyers are prepared to pay, given the current debt costs of the SOFR plus 275 and the rent growth projections that are moderating from 10% in 2021 to about 3.1% today. So what's driving it? We talked about sellers pricing their assets too high. That's definitely one of the main factors. The other one is supply dynamics that are actually working in this market's favor compared to the rest of the nation. So when we took a look at this, we're currently sitting at 126,743 total units of multifamily inventory in the Hampton Roads. That's properties across all asset classes. But here's what's interesting. The last time we had this level of inventory was just last year. We're not seeing the massive supply surge that's crushing markets like Austin, Phoenix, and Charlotte. Just 3.5 years ago, we were only about 119,000 units in the market. Inventory has grown, but not at the pace of deliveries we saw in 2020 and 2021. We all remember that period. It's part of what drove valuations to unsustainable levels because there wasn't enough supply relative to demand. Not to mention all these institutional capital that flooded into the Hampton Roads during the pandemic, driving cap rate compression down to the low fives. Today, we're sitting at just over 126,000 units of inventory. So you have more choice than you did 3 years ago, but you don't have the oversupply problem plaguing the Sunbelt markets. And because the supply picture is actually relatively healthy, you don't have catastrophic vacancy even with moderating demand. So the vacancy rate in the Hampton Roads is 6.1%. Compare that to national average of 8.3%. This market is outperforming the nation by 220 basis points on vacancy alone. We're at 5.8% average cap rate for the overall market. That cap rate is what I reference every single quarter. We're always in that 5.8 to 6.4 range depending on asset class. The market feels stable at the headline level, but it's really not when you peel back the layers, which what we're going to do in this video. So if you go back to Q1 of last year, we were at 5.9%. Now this is a rolling 4-quarter data, meaning we're using 4 quarters of transactions to get that average cap rate. It smooths out the seasonality and the cyclical nature of the market. But as a whole, we're looking at a 6.4% market cap as of Q4 2025. The average price per unit across the asset class is around $170,000 per unit. That's actually below replacement costs for new construction in this market. Cap rate is the equilibrium point where buyers and sellers meet. It's that pricing mechanism tells you where the market is really trading. If you think I'm doing a good job with this video, or at least you appreciate the time it's taken to compile all of this multifamily and Hampton Roads specific data, hit the like button, consider subscribing if you haven't. So how does this cap rate break down by asset class? Class A, your trophy institutional product, is trading at 6% to 6.1% cap rates. Class B, workforce housing, is 6.4 to 6.5. Class C, value added, at 6.7 to 7.3. So when you look at this spread, there are some submarkets where cap rates are holding relatively firm, and there are some submarkets starting to see expansion. See, Virginia Beach, which represents 27.8% of the total inventory in this market, is one of those more stable submarkets. Chesapeake and Suffolk are seeing modest cap rate expansion as buyers reprice for slower rent growth and the operational complexity managing Class C assets in secondary locations. This chart right here puts into perspective everything that's happening right now in the Hampton Roads multifamily. It's that impactful. So let me show you exactly what I mean. In the last 12 months, Hampton Roads absorbed 2,300 units. That's above the 10-year historical average of about 2,000 units per year. But here's what's critical. In that same 12-month period, only 1,598 units were delivered. So demand outpaced supply by almost 800 units. That's a healthy market dynamic. Now here's a gap between what's being delivered and what's being absorbed. And that gap is working in favor of landlords and existing owners. If you go back to 2024, we delivered 3,450 units, the highest delivery year in a decade. Absorption in that same period was 2,200, so we overshot demand. Vacancy ticked up from 6.1 to 6.9% briefly in 2024, but as Q4 2025 vacancy was back down to 6.1% because deliveries have slowed down dramatically. So what happens in future quarters if deliveries continue to slow and absorption holds steady around 2,000 units per year? That's a setup for rent growth acceleration and cap rate compression, because right now there's only 650 units under construction across the entire Hampton Roads region. That's a 0.5% expansion of total inventory. Compare that to the 10-year average of 2,600 units under construction at any given time. You're way below the historical average for new supply, and most of those 650 units under construction are in Virginia Beach, about 132 units. After that, you've got 200 units in Chesapeake, 192 in Norfolk City, and 126 in Williamsburg. The supply pipeline has essentially shut down. Opportunity. It's opportunity for operators who can underwrite conservatively at today's basis and hold for the next 24 to 36 months. Everything that's going to follow this supply slowdown is going to be more advantageous for landlords and existing owners. Because we talked about price reductions, and there are a lot of them on the sell side, you're going to see more opportunities to acquire at a discount to replacement costs. You're going to see bigger price reductions from sellers who have to transact. You're going to have sellers who are going to sit on the market, and we're going to look at days on market here in a bit, but you're going to have sellers exiting the market because they're not getting the price they need, or if they have to sell because of loan maturity. They're going to have to sell at a price that actually clears the market. This market is setting up for a strong 2026 and 2027 as supply continues to undershoot demand and as the debt costs even normalize. If your debt is coming due in the next 12 to 18 months, it's time to re-underwrite your position and understand what your options are. If you're looking to acquire, let's align on where the best risk-adjusted returns are in this market.